Hey traders, Akil Stokes here. Welcome back to the Trading Coach Podcast. Got another video episode for you today. So if you want to see everything that's going on, make sure you head over to Spotify or YouTube to check it out. If you're cool with just the audio version, then stay exactly where you're at. Now today's episode is another listener requested episode, and we're going to dive into two really important topics, right? One, how to stop missing trades, and two, how to properly evaluate your trading process so that you don't miss trades. So I guess it's kind of one topic, but I want to take it in two different directions. So the question that I got from our trader was, I have it pulled up somewhere here. It says, Akil, first year trading here, currently down 1% for the year. However, after my weekly review, I realized, dun dun dun, cool zoom in effect there, hopefully. I realize I have missed some trades and my actual P&L, profit and loss or return on investment, should be not negative 1%, rather plus 11%. How do I stop this? And there are two places I want to take this. We're going to start one with trading routine, and we're going to start finish two with proper trade evaluation, proper trade process evaluation. So, trading routine. No matter what you do in life, it is important that you have a routine, right? Routines are beneficial for various reasons. There's the mental side of keeping us comfortable, and the more comfortable we are, the more confident we are, and the more confident we are, the less mistakes we make. We had a whole thing in my live trading room this morning about that, how, visualization, and rehearsing your trades, and we'll probably make that another podcast episode, so I don't want to spoil it, but we do that so we can become comfortable and confident, and when we're confident, we do less of the things that cost us money. So routines are awesome because of that. Routines are also awesome because they allow us to really check all the boxes and limit our chances of missing anything. And that's what it sounds like this trader's issue is. It wasn't that he was necessarily trading poorly and taking bad trades and doing dumb stuff, taking stops out early or taking targets early and moving stops back. It sounds like the main culprit, dun dun dun, I'm in the mood to do that today for some reason, is he's just missing trades. And although I don't know the details of this trader and their trading situation, typically, and this comes from the knowledge of me going through 20 years of trading and me working with hundreds of thousands of traders over the last 15 years, usually that comes from traders not having a consistent approach in the market. Sometimes it's actual strategy if you're kind of just trading everything, but sometimes it's actually just a consistent business-like approach to the market, meaning that traders are not in front of their charts during the times that they need to be in front of their charts, and therefore when they get back to their charts, they're like, man, I missed that, right? So having a routine is important, and again, there are many ways to make a routine, but the main part of the routine or your business plan is that you need to have either A, dedicated chart time, or B, dedicated time to check charts. So if you're a day trader, you're probably going to lean more towards the dedicated chart time, meaning that day traders typically have a block schedule of when they want to trade. When I used to day trade, my block schedule was 8 to 10 or 8 to 11, ended up being like 7:30 to 10:30 after that. We made some adjustments, but originally it was 8 to 11. So it was during that period, 8 to 9, 9 to 10, 10 to 11, that 3-hour period, that I had to be in front of my computer. Yeah, I could take bathroom breaks and snack breaks and stuff like that between candles printing, but I couldn't just go out and play a round of golf. I needed to be there because that was my trading day. Now, in front of that, I also had a pre-market and a post-market routine as well. So I had a pre-market routine where I would come in, I'd do pre-market analysis, I'd stop, I'd eat breakfast, I'd hug my kids and take some downtime. That downtime was actually very important to kind of disconnect from the charts. Staring at the charts for 3 hours in a row is very, very hard. Staring at the charts for 1 hour in a row is very, very hard. And sometimes what happens is our mind gets cloudy and we stop seeing things. If you ever backtest it, right, you go through so much data that you kind of just you get loose in your analysis and you're not as sharp. So I've always valued taking breaks. So I would wake up, I would do my pre-market analysis, then I would take a break. Then I would do like 45 minutes of day trading, then take a break. Then 45 minutes of day trading, then take a break. So it would really be split up like that. That way I stay sharp. And then there's the post-market analysis as well that we'll talk about a little bit later. But as a day trader, you should have that routine, and you need to consistently stick to that routine for whatever your day trading days are. As a swing trader or an intraday trader, someone that doesn't necessarily need to be actively in front of the chart. So if you're trading maybe an hourly time frame and up, you don't necessarily need to be in front of the charts for 3 straight hours. For example, if I'm trading a hourly time frame and I need a higher high, higher close entry, and we're currently printing the first bar of that, I've still got a minimum of an hour, probably an hour and some change before I can do anything on the chart. So it's okay if I kind of step away and come back, as long as I come back in time to do what I need to do. But we still want to have that pre-market analysis. Again, that's the time where we're analyzing the charts and we're just looking to do analysis, right? I mentioned this in the interview. If you guys saw this interview I did with T3, where I said creativity is so important in trading, and I don't go into the markets looking for trading opportunities. Rather, I go into the markets looking to do analysis, and the trading opportunities come to me, right? Kind of like the ladies, guys. I don't go out looking for ladies. I let the ladies come to me. I'm happily married. I don't want any ladies coming to me. Ladies, if you were considering coming to me, go the other way. 1, I don't want you. And 2, my wife is a bulldog and you don't want those problems. But that's an analogy that I'm using and now regretting. Yeah. Anyway, so you want to have that pre-market routine where you're being creative. You're letting the trades, come to you. And then you kind of know what's on your radar. And then when it's time to lock in for your trading day, you know exactly what to look for. But if you are someone that's on an hourly or a 4-hour time frame, you don't have to actively stare at your charts the whole time, but you do need to either set alarms at crucial price points. So if price gets to a certain level, then an alarm goes off and you need to go back to your charts and take a look at it, or have an understanding of how many hours you need for your signal to be created. A lot of this is going to be dependent on your trading style. Are you an aggressive trader that just puts limit orders on? Are you a more action-based trader? I don't know what the word I'm looking for. More hands-on type trader where you're looking for certain price patterns. Regardless, when you do your analysis in the morning, when you block off the trading opportunities that are on your radar for the day to come, you want to write down, hey, make sure I check out euro dollar, could have entry at 10 o'clock. Make sure I go over to euro yen, could have an entry reason at 11 o'clock. And you need to make sure that you're able to be around your charts at those times. Now, if you're saying to yourself, Akil, what if I don't know if I can be around my charts at those times? Well, 2 things. 1, you should always be creating your trading strategy around your life. So if your life is so busy, like I've worked with a lot of truck drivers who are like, man, I just can't randomly check my charts while I'm driving on the highway, right, every hour, then probably that type of trading style shouldn't be for you. We've advised those guys to be like, hey, maybe be an end of day trader, or maybe be a day trader where you have a short period before you get on the road and you do blah, blah, blah. So you want to always create your trading strategy around your life. So 1, you need to make sure that you have the ability to be around charts so that you can actually do it. Or 2, make sure you have some type of mobile app where you can do your analysis on your desktop or your laptop preferred beginning of day, and then all you're kind of doing is managing or putting the sprinkle on the cupcake at the end from your mobile device. Now, part of that routine, which is going to seamlessly transition us to our next topic, is post-market review. Post-market review is important. We've spoken about the importance of journaling and all that fun stuff. I actually have an idea in my head right now. I should write this down. I don't have a pen, about another Trading Coach podcast episode I should do on the more technical side of post-market review. But for purposes of this question, with the trader's struggle being that he's missing trades, we should, or he should implement, all of us should implement a post-market routine, right? A post-market journaling evaluation that centers on missing trades, right? So I haven't said this in a while on the podcast, but something that I live by and something that we preach and teach over at Tier 1 Trading is process over outcome, meaning that the process of how you go about trading is more important than the outcome. Long story short, outcomes could be completely random, right? We mentioned this in a podcast last week. And you could be doing everything right and still be wrong. You could do everything wrong and still be right. So, those are all short-term type of deals. Bigger picture, the law of large numbers comes into play, and the process of doing the right thing should get you the expected right result. So that's what you want to focus on. So for this trader, here's what they should do. After each day, they should do a review. After each day, maybe after each week, right? Whatever your time allows. I would do it each day just so it's fresh in your mind, but you could do each week as well. After each something, this trader should go back through their trading day or trading week, whatever time segment it is, and they should go through the market, reanalyze everything, and look for every single trading opportunity that they missed. And what they'll notice is this. They will see that, one, they have their spreadsheet, their journal of everything that they took. That'll be your A test, right? Your B test will be all the opportunities that you missed. And you'll be able to clearly see that, boom, here's what I took, here's what I missed, this is a problem. The next step is we want to identify why are we missing those trades. Hopefully we cured that problem in the beginning episode or beginning part of this episode where we spoke about routine, but you need to write down, hey, trading signal was at 10 o'clock. I was at work. I was in bathroom. I just wasn't paying attention, right? Discover the reason for why you missed it. Put those in your notes. And then as you progress, try to identify why those things are happening and what you can do, what solutions you can put in place to stop them from happening, right? Maybe there are some things that are unavoidable, that is life. But I bet you're going to find some things that you can certainly work on, whether it's like, hey, just stay at my computer for one more hour, or hey, be sure to set an alarm because I clearly missed it just because I didn't know price was there, right? Those are going to be helpful tips. Something else this is going to do is this is going to sharpen your RAS, your reticular activating system, right? Your eyes and your brain's ability to pick out the things that it needs to pick out of the market. And understand that the newer we are as traders, the less good we typically are, right? We are still developing. We're going to miss stuff. We're going to make more mistakes. And part of that does come from missing trades. Look, yours truly, I miss trades as well, right? I do analysis. I do it every day. I'm very consistent. I've been very consistent for a very long time. But every once in a while, I see something that, during my post-market analysis, and I'm like, man, I could have gotten involved in that. Now, I'm also fortunate to work with a great group of traders on a regular basis who have more eyes. So it's not just my eyes. I've got hundreds of eyes on the markets at the same time. So they'll pick up things that I miss. I'll be like, thank you, George. I'm in that right now. Or F you, George, it lost. I wish I would have missed it. But not everyone has that community to work with. So what you're going to notice is that as you do this post-market review, not only are you going to find opportunities that you missed for whatever reasons, but you may find opportunities that you just didn't see just because your eyes missed them. And that's going to help train you, and you're going to get better and better and better at recognition. And by simply doing that practice, practicing riding a bike, practicing dribbling a basketball, practice swinging a tennis racket, whatever it may be, you are going to get better at your analysis, you're going to get better at your recognition, and therefore you're going to miss less trades that way, right? So there's kind of the self-sabotage and then there's the natural misses. If you can kind of reduce both of them, then your A and B tests are going to start to get more and more similar. Then if you're someone that's kind of like games and challenge based, right? Make it a challenge, right? Give yourself a grading system. We do this a lot normally with kind of regular post-market analysis where we're looking at analysis, we're looking at entries, exits, stops, trade management. Make a game out of your recognition. So what you do is you do that A/B test, right? A is what you took, B is what you should have had, and give yourself a percentage. I took 4 trades this week and I should have taken 10 trades, right? So you have a 40% trade recognition rate. That's 40% TRR, right? So play the game. Next month, I'm going to try to have a 41% trade recognition rates, right? And you do your test, you're like, oh man, I got the 42, 45, that's awesome. And play that game where each month you try to get closer and closer to 100%. And that's gonna be the little carrot that's in front of your face that keeps you motivated. It keeps you motivated to stick to your routine. It keeps you motivated to kind of analyze the market more intently because you're actually fighting for something that isn't profit based. It also kind of tricks your mind into worry about trade hunting because you're not looking for like money. You're worried about doing the process right way, which in turn will make you a better trader. And then there was one more thing I want to say, but I just forgot it as I put in that last example. We spoke about it a few podcast episodes ago. It was about motivation and development, and I'm going to have a brain fart. I'm going to be very upset about forgetting it, but it's gone. So I'll have to revisit it another time. Oh, I remembered. It was actually 3 days later when I remembered, guys, but thanks to editing and me never washing this shirt, you'd never know the difference. But we spoke about in not a recent Trading Coach podcast episode, but a past one, right? One of the 12,000 in the past, about rewarding yourself off of the process. So as you play this game of trying to consistently increase your TRR, your trade recognition rate, reward yourself. If you have a week or a month where you bring your rate up, give yourself a prize, right? Buy yourself a snack, go to a sporting event, do a fun dance. I don't know, whatever it is that gets you going, reward yourself, right? And that's going to be that internal motivation or internal motivation that gets you even more pumped about doing the right things the next time, because as you continue to do the right things, not only are you probably going to be more profitable in the market and turn that -1 into +11, but you're also going to gift yourself with cool things, and we all like cool things. Speaking of cool things, I got a cool gift for you. It is a free trading computer builder or buyer's guide. There's a link below in the podcast notes or the YouTube video description. Click on it. It tells you everything you need to know about how to build or what components you need in a trading computer, whether you want to build one yourself or whether you want to buy one. If you do buy one, I believe you get a little bit of a discount if you use that link as well. So check it out. Hit that like button before you go if you haven't done so already. And until next time, plan your trade your plan. Take care.